Welcome to the Deep Dive, the place where we take the most complex, granular industry reports, stacks of research, and strategic notes, and we distill them into immediately actionable, understandable knowledge for you.
And today, we are strapping in for a deep dive into the high-stakes world of Essland's hotel industry.
It's a market defined by, some really intense economic pressure, fierce competition, and this constant need to maintain incredibly high service standards while you're battling rising costs.
Exactly. So our mission today is to decode this environment, and we're going to use a specific 4-star chain, Levwell PLC, as our case study.
Levwell is a really fascinating subject. I mean, we've got their operational blueprint, their strategy, their financial data.
Everything.
We're going to break down the foundational industry context first, the structure, the core challenges, the KPIs, and then conduct a really extensive review of Levwell's unique owner-managed model, its specific risks, and of course, its financial health.
And here's the central puzzle we have to solve. The typical operating profit margin for hotels in this challenging market, it hovers around 10%. Levwell, however, has been consistently achieving margins closer to 14%.
Wow.
So why? What strategic decisions, what operational efficiencies, or what kind of pricing power allows them to pull nearly 40% more profit than the average competitor?
That's the strategic blueprint you're getting today.
It is.
And this dive, it's invaluable far beyond just Essland. It's a comprehensive look at strategic management, performance measurement, and responding to those inevitable external pressures like economic downturns and, technological disruption, all distilled into one company's struggle and success.
So shall we start with the basics? What even is a hotel in this context?
Let's do it.
To understand Levwell, we first need to define the fundamental product in Essland. A hotel offering is a complete experience. It's far more integrated than simply, selling a bed for the night.
That's so right. While accommodation is, of course, the core, the secondary facilities are where the capital investment and the real differentiation happen. For instance, you've got quality restaurants and bars, which ideally should be open to non-residents to really maximize revenue.
A point we'll come back to with Levwell.
Oh, definitely. But for 4-star properties and above, we're also talking about specialized facilities. Swimming pools, fitness centers, luxurious spas, and these big spaces for private events like weddings, major business meetings, or conferences.
These ancillary services are absolutely essential for diversifying revenue and just for achieving that necessary quality tier. It's a non-negotiable.
So who are they serving? Guest segmentation is what drives the design and the strategy here.
And we generally categorize guests into 2 main groups, and they each have really distinct needs and priorities.
First up, you have the business traveler. Their priorities are completely focused on convenience and productivity.
Right. They need fast access to client locations, which often means they're picking hotels near business hubs.
And above all else, they demand fast, reliable, and secure Wi-Fi connections. Their stay is just driven by a logistical necessity, and they often aren't that price sensitive if the cost is covered by their employer.
But the leisure guest, conversely, is Levwell's primary focus.
Yeah.
These are your vacationers, and their needs shift completely to the overall atmosphere and the range of facilities. They're looking for a unique, relaxing environment.
One that often leverages the local area, which is exactly why Levwell targets coastal or rural locations.
Exactly.
The leisure traveler, though, because they're paying out of their own pocket, they tend to be more price sensitive.
They do, but they compensate by typically staying for longer periods, which reduces the effective cost of room changeovers and housekeeping over the duration of their visit.
So it can benefit the hotel's margins if it's managed well.
If managed well, yes. Now, the quality standard is non-negotiable in this market, and it's centrally monitored by Visit Essland.
Right. They're the ones who award the star ratings annually, from 1 star for the most basic service all the way up to 5 stars for the most luxurious offering.
And those ratings are built on 3 core criteria: room quality, size, amenities, service quality, the competence and courtesy of the staff, and the overall range of facilities available on site.
And achieving a higher star rating is a huge commitment to higher capital expenditure and just stricter operational standards.
So given Levwell's position, we need to really focus on the 4-star standard. This is the sweet spot where a hotel moves from essential services to a comprehensive luxury offering. A 4-star property has to offer all the basics: private ensuite, secure guest room, breakfast, but it must also operate a full restaurant and a bar.
And the in-room amenities are extensive too. A quality television, ironing facilities, reliable Wi-Fi, complimentary tea and coffee stations.
But the true differentiator between a 3-star and a 4-star is the mandatory provision of leisure facilities.
This is the big jump.
It is. To hold that 4-star plaque, they must have things like a swimming pool, a fitness center, or offer spa and beauty treatments.
And that mandatory investment explains why 4-star properties carry a dramatically higher capital cost profile than 3-star ones, and why their prices naturally reflect this quality tier.
Looking at the macro structure of the Essland market, we see a really dynamic mix of large chains and smaller independent operators.
Yeah, the chains offer standardized experiences across multiple locations under a single brand. This consistency reassures guests, reduces risk, and provides the chain with powerful economies of scale.
Especially when they're negotiating procurement deals or running centralized marketing campaigns and online booking systems.
Right, and then you have the independents operating as single businesses. They gain flexibility, they can create a unique, highly localized guest experience.
But by definition, they lack the scale benefits that chains enjoy, making their operational costs potentially higher.
And despite the dominance of these big recognized brands, the independent sector is still highly significant. As recently as 20x4, independents accounted for 48% of the total guest room supply in Essland.
But that figure is rapidly shrinking due to market forces.
It is.
Exactly. We are seeing constant consolidation. Larger chains are acquiring smaller chains, and both are actively buying up independents to convert them into branded properties.
And beyond acquisition, chains are also driving growth organically by building new sites and increasingly through franchise agreements.
So this systematic growth strategy means that while independents currently represent a huge slice of the pie, their market share is under sustained strategic threat.
Okay, let's transition now from the physical structure to the operational structure. How do these hotels actually make money? We see two dominant business models: owner-managed and franchised.
The owner-managed model, which Levwell uses exclusively, involves the owner, whether it's a large chain or a single business, controlling and managing every single aspect of the operation.
So that gives them maximum control over strategy, quality, day-to-day decisions.
Yes, which is essential for maintaining a high-quality, non-standardized brand like Levwell.
But the trade-off, I assume, is that the owner is responsible for all the capital investment and carries maximum operational risk.
All of it. The franchised model, on the other hand, operates as a licensing arrangement. The franchisor, the chain licenses its brand name, its proprietary systems like the integrated reservation system, and provides operational support and marketing guidance
to the
franchisee, who in turn pays a fee to the chain, owns or leases the physical building, and manages the day-to-day operations.
And they gain speed of entry into the market and brand recognition, but they have to strictly adhere to the franchisor's quality standards.
Right. This model allows chains like TravelWise and Yelton to scale rapidly across Essland without tying up vast amounts of capital in property ownership.
And we see this mixture clearly in the market concentration data. The 5 largest chains account for, 23.1% of all rooms, confirming a concentrated but still highly competitive market.
And if we look at those top 5, you can see the strategic split in action. Beston and Haliot, for example, are owner-managed chains, signaling a deep, ongoing capital commitment to owning their operational assets.
Right, whereas chains like TravelWise, Vacant, and Yelton primarily use the franchise model. They're prioritizing asset-light growth and speed.
It's a fascinating choice because even within the 4-star segment, where quality control is paramount, we see both strategies thriving.
So now let's talk about the money specifically, where a 4-star hotel's money actually comes from. Room revenue is the primary source, but it's far from the only source.
Not at all. Typically, accommodation generates between 60 and 70% of total revenue.
Okay.
The second biggest stream is food and drink sales, accounting for about 25 to 35%, and the remainder 5 to 10% comes from other services.
The lucrative events, conferences, and spa treatments we mentioned earlier.
Exactly. So if a hotel is struggling to hit that 60% room revenue threshold, it means they're either highly reliant on those lower margin ancillary services,
or they're just struggling with occupancy.
And that brings us to the crucial industry benchmark. For a hotel operating in the volatility of the Essland market, the typical operating profit margin is established at around 10%.
That 10% is the measure of success. It indicates strong management and an ability to navigate intense competition and rising costs.
But wait a second. That figure is the industry average. As we established right at the start, Levwell Plant consistently outperforms this benchmark.
Right, they're hitting margins of 13 to 14%. Doesn't that suggest the competitive pressures we just described aren't hitting them as hard as their rivals?
It absolutely does. This superior performance is the strategic puzzle. For Levwell to consistently generate 30 to 40% more profit per dollar of revenue than the average competitor, it means they possess a significant competitive advantage.
So we need to dissect their strategy and operations to figure out if that advantage comes from superior cost control, superior pricing power derived from their unique brand, or both.
Exactly. That high margin is the ultimate goal, and the rest of this deep dive is devoted to uncovering its source and its sustainability.
Okay, so now we shift to the forces actively trying to drag that 14% margin back down to 10. The Essland hotel sector is facing a severe combination of external and internal pressures, what we've dubbed the quadruple threat.
The first two threats are macroeconomic. Essland is grappling with an economic downturn and significant global volatility,
Which directly impacts demand.
It directly impacts demand, particularly hitting Levwell's core leisure guest market, who become increasingly price-sensitive and may choose cheaper alternatives or postpone travel entirely.
And even with lower demand, the second threat, rising costs, just refuses to abate.
It doesn't. High inflation is driving up the expense of everything required to maintain a four-star property. Regular maintenance, mandatory renovations every decade or so, and especially the skyrocketing costs of energy consumption.
If you have a mandated swimming pool and a restaurant, your fixed utility costs are substantial. That makes this pressure point particularly painful.
Then the third threat is the chronic staffing crisis. This is perhaps the most pervasive and damaging structural issue in the industry. We see alarmingly high employee turnover rates driven by, poor compensation relative to the difficulty of the work, and the notorious antisocial hours.
The late shifts, early starts, weekends.
Exactly, which severely compromise staff quality of life. And high turnover constantly forces the chain to invest in costly recruitment and training.
And finally, the fourth threat is simply intense competition. Whether it's from rival chains consolidating the market or independents fighting for niche customers, the need to differentiate the brand and justify a premium price point never stops.
If Levwell rests on its laurels, that 14% margin will vanish overnight.
Wow. And then you have external disruptors compounding all of this.
Right, external disruptors that are fundamentally changing the shape of the accommodation market.
Home sharing models are the obvious challenger here.
Of course. By allowing guests to book private homes, they have added massive amounts of new, often unregulated supply to the accommodation market. This direct competition puts constant downward pressure on pricing for traditional hotels, especially in the leisure segment.
And secondly, there's the unavoidable pressure of sustainability and environmental concern.
Guests and corporate clients are increasingly factoring carbon footprint, waste management, and water and energy consumption into their booking decisions.
So hotels are forced to invest in sustainability initiatives simply to remain palatable to a growing segment of environmentally conscious customers.
And moreover, this trend has a direct negative impact on the business segment. Companies are consciously reducing their environmental impact by cutting back on air travel and favoring online meetings.
Which directly reduces the demand for business days and corporate conference bookings across the entire industry.
But the industry is responding aggressively, and technology is the primary weapon against these threats.
Right. The drive for efficiency and a better guest experience has led to widespread adoption of automation and connectivity. We see mobile apps being deployed for incredibly fast check-in and check-out processes, just eliminating friction.
And these apps also provide guests control over their rooms, temperature, lighting, service ordering, enhancing convenience, and reducing the need for constant front desk interaction.
Then you have artificial intelligence entering the service layer through chatbots.
Right. These AI-driven tools can handle routine guest queries instantly. What time is breakfast? Where is the nearest attraction? And that frees up human staff to focus on high-value, personalized service interactions that truly define the four-star experience.
But this increased integration creates a major liability: data security.
Oh, a huge one. The reliance on centralized booking systems and interconnected hotel management systems means the entire operation hinges on cybersecurity.
And Essland maintains extremely strict data protection laws. Any breach or noncompliance can result in substantial financial penalties and, perhaps worse, devastating reputational damage.
The technical risk profile has escalated alongside the technological sophistication.
Okay, but the single biggest technological advantage in pricing, which it seems Levwell is lagging on, is yield management.
It is. This is the sophisticated software system used to maximize revenue.
And yield management uses data analytics, often powered by AI algorithms, to adjust room prices dynamically, sometimes multiple times a day.
It's an adaptive pricing strategy that seeks the perfect price at any given moment.
How does it do that?
Well, it achieves this by synthesizing historical booking trends, current occupancy rates, competitive pricing data, and even local event schedules. If demand is predicted to be low, the system automatically drops the price slightly to fill the room rather than leave it empty.
And if demand spikes due to, say, an unexpected local festival,
the price instantly rises to maximize the revenue captured. This contrasts sharply with manual fixed-rate pricing, potentially leaving millions of dollars in optimization on the table.
Before we zoom into Levwell, let's just quickly acknowledge an emerging financial innovation driven by this challenging economic environment: sale and leaseback arrangements.
Yes, this is a strategy for asset-heavy chains like Levwell to boost liquidity. The hotel company sells the physical building to an investment firm or a property owner for a large cash infusion, immediately strengthening their balance sheet.
And then they just lease the building back from the new owner, continuing to operate the hotel under a long-term contract.
Exactly. So operationally, they remain in control, but they transition from a property owner to a tenant, trading fixed assets for operational cash flow. This is a critical factor for chains like Levwell, given their high capital commitment.
Okay, so ultimately, all this market pressure comes back to one thing. Success is defined by the guest experience.
That is the foundation. That is what justifies the price point and drives loyalty. And to support that experience, hotels have to nail the fundamentals. Quality and comfort of the room, impeccable hygiene and cleanliness, a desirable range of facilities, the quality of staff service, robust security, and the sheer convenience of the booking and departure process.
And location and ambiance, especially for leisure guests, they just amplify all these factors.
Right. And from a strategic perspective, because of the intense competition, success also requires aggressive marketing, maintaining a strong, recognizable brand, and deploying competitive and optimized pricing strategies to capture every potential booking.
Okay, so let's apply that intense industry context directly to Levwell Play.
Let's do it.
Levwell is a well-established 40-year-old chain in Essland. They operate 35 properties, all consistently rated 4-star, and every single one is operated under the owner-managed model,
which grants them total strategic and operational control, and their strategic positioning is laser-focused. They target primarily leisure guests.
Physically, all their hotels are designed for consistency and functionality. They generally feature about 80 guest rooms each, along with a full suite of required 4-star facilities, restaurant, bar, and leisure options.
And their choice of location is key. Levwell deliberately places its hotels in rural or coastal, seaside areas.
Strategically, that reduces competition from high-density city center hotels. But we have to acknowledge the implication there. Their average daily rate, or ADR, will inherently be lower than that of major urban competitors.
It will. But here is the essence of their brand proposition, which justifies their premium 4-star pricing despite that lower ADR environment.
What is it?
They reject the standardized cookie-cutter design that's so typical of large chains. Each Levwell hotel has a distinctive style, often drawing on local history, architecture, and its surrounding environment. This non-standardized individuality is their core differentiator.
Aimed directly at attracting leisure guests who want atmosphere and authenticity over predictable corporate uniformity. Their growth model is slow and measured. Levwell has grown purely organically so, building new hotels themselves rather than through external acquisition.
And that allows them to maintain that unique, non-standardized brand character and ensure perfect adherence to the owner-managed operational strategy across all 35 sites.
Strategic management of this growth falls to the business development manager, who performs painstaking assessment of new sites based on 3 factors: potential guest demand, the presence of compelling local attractions, and the existing competitive landscape.
And this slow, deliberate approach contrasts sharply with the rapid scaling of franchised rivals. It also shows they are pragmatic. 7 years ago, they closed 2 hotels that were deemed unprofitable.
So they're willing to prune underperforming assets to protect the overall brand and financial health.
Right.
Now let's look at Levwell's income mix, comparing it to the industry benchmark,
Okay. Levwell generates 62% of its revenue from room sales.
which is slightly below the midpoint of the industry average of 60 to 70%.
Right.
Correspondingly, their food and drink revenue is 33%, which is toward the higher end of the industry range, and the final 5% comes from other, specifically private events.
This slightly higher reliance on F&B is structurally important because the source material explicitly notes that Levwell's profit margins on food and drink are lower than their margins on room revenue.
Yes. So they are succeeding despite relying more heavily on a lower margin revenue stream.
And this brings us to a crucial self-imposed limitation. Levwell's policy dictates that only guests staying in the hotel can eat in its restaurant or use its bar. They actively restrict access to non-resident diners.
They do.
But wait, why would they do that? In a rural or coastal setting, attracting local dining traffic could provide a small but reliable year-round revenue stream that helps offset that massive seasonality swing.
It could.
It seems like an intentional forfeiture of potential profit. What is the strategic intent here?
The intent is almost certainly to preserve that core brand value of exclusivity and the exceptional guest experience.
I see. By ensuring the bar and restaurant are used only by guests, they maintain a private, intimate atmosphere that is less congested and chaotic than a public venue.
So it's a strategic choice. They sacrifice lower margin, high volume external revenue to protect the exclusivity that allows them to charge a premium room rate.
Which is where that 14% margin originates. They are prioritizing the margin from room revenue over the volume from F&B.
Fascinating. Shifting to governance, Levwell maintains a structure that supports their owner-managed control. They have a board of 10 directors, 5 executives covering the core functions, CEO, CFO, COO, CMO, CPO, and 5 non-executive directors, including the chair, ensuring external oversight.
And more strategically relevant than the exact numbers is the function of the internal monitoring. They utilize an internal audit department, which is crucial for an operation managing 35 non-standardized properties. Internal audit monitors the effectiveness of their risk management and internal controls. They conduct regular inspections of all hotels to ensure compliance with financial and operational procedures, ensuring that Levwell's unique brand standards are actually being delivered consistently on the ground.
Okay, so the biggest operational challenge that stems from Levwell's leisure focus is the dramatic seasonality impact.
Oh, it's huge. Looking at the data for the year ended June 20X5, the swing is massive and must be managed extremely carefully.
The peak season, essentially the summer months of July through September, sees occupancy rates surge to a really healthy 80 to 90%.
And naturally, they maximize pricing here, with the average daily rate hitting $225 in the middle of summer. This 3-month window is responsible for generating the majority of their annual profit.
But the collapse in the off-peak season is equally severe.
It is. We see a sharp drop in November, stabilizing at the lowest point during January and February, where occupancy plunges to only 50% and the ADRs reduce to $150.
Managing staff levels, maintenance schedules, and procurement across a 40% occupancy swing. That creates massive instability for managers on the ground.
And their pricing mechanism is their operational response to this. Head office sets the basic annual rates, reflecting the peak and off-peak differences. But critically, hotel managers have the autonomy to apply localized discounts of up to 25% during slow periods.
Which allows them to react quickly to fill rooms if a week looks particularly empty.
It does. However, this manual fixed percentage discount system is a clear technical lag compared to the industry cutting edge.
Right, the yield management we talked about.
Exactly. Competitors using dynamic AI yield management are optimizing every single room price every day based on real-time data. Levwell is relying on a manager manually hitting the 25% off button.
So if we were to quantify the risk, Levwell is potentially leaving significant revenue on the table.
They are. A dynamic system could identify guests willing to pay a 10% premium, or who only need a 15% discount, allowing Levwell to capture a much better marginal return on every single room sale during the off-season.
Which could significantly bolster the entire year's RevPAR. Their pricing is currently robust, but clearly suboptimal compared to technology-enabled rivals.
Let's look at the actual operational flow, the guest journey, to understand the efficiency levers they control.
It all begins with reservations, mostly via their central website, which utilizes a single integrated booking system.
And this system is technically vital because it ensures real-time availability and pricing, instantly preventing the catastrophic error of double booking rooms across their 35 properties.
Then the on-site process is handled by check-in, check-out procedures. Staff follows strict SOPs for identity verification, providing room access, and explaining facilities.
And checkout is the final point of financial control, reconciling the accommodation bill with all the incidentals racked up in the restaurant, bar, or spa.
Housekeeping is the cornerstone of maintaining the 4-star experience, where cleanliness and comfort are non-negotiable. They are governed by detailed standard operating procedures, or SOPs, for every task.
And to ensure quality control, the housekeeping manager samples rooms daily.
We noted earlier the detail that they outsource their laundry services, washing all the linens and towels.
Mm-hmm.
And while that seems granular, this is a shrewd strategic decision. By outsourcing, they convert a large fixed capital cost, like buying and maintaining industrial laundry machines, and a variable labor cost into a manageable external operating expense.
And that flexibility is crucial for handling the massive volume swings between the 90% peak occupancy and the 50% off-peak trough.
Maintenance handles the routine upkeep, the plumbing, the electrics, fixing furniture, which prevents minor issues from damaging the guest experience.
And for major works, like the planned 10-year refurbishments, they centralize the negotiation and use external contractors, maximizing consistency and pricing.
Regarding people, Levwell explicitly states that employee satisfaction directly correlates with service quality.
They do. They even implement an employee recognition program, offering cash rewards and vouchers nominated by colleagues or managers to boost morale among their predominantly part-time operational staff.
Their procurement strategy is interesting because it balances the need for brand localization with centralized efficiency.
How so?
Well, local restaurant managers handle contracts for locally sourced seasonal ingredients, which supports the unique regional character of each hotel.
Okay, but
Now, let's return to the strategic technology choice. The Integrated Hotel Management System, or HMS. This system is the operational backbone for coordinating reservations, managing billing, tracking room status, and logging maintenance needs across all 35 hotels.
And the key risk lies in its hosting architecture. Levwell hosts the entire critical HMS infrastructure on in-house servers at head office.
Specifically opting not to use resilient cloud computing services for hosting or data storage.
Yeah.
This decision is a major strategic vulnerability. By hosting in-house, they retain full responsibility for physical security, disaster recovery. What happens if the head office building loses power or floods?
Exactly. Not to mention regular patching and server maintenance, all high-cost, high-risk operational burdens.
Whereas cloud computing providers specialize in offering redundancy, geographical distribution, and advanced security, turning those unpredictable capital and risk costs into manageable external operating expenditures.
So Levwell has essentially accepted full in-house technical debt, increasing the likelihood of costly downtime and internal security failures, directly amplifying their technology and data security principal risks.
And this technical architecture decision is framed by their core philosophy. Levwell's mission is to provide an exceptional experience for every guest every time they visit.
And this mission rests upon 5 core values: care staff caring for guests' first-class service, positivity, teamwork, and responsibility.
Crucially, the value of responsibility includes acting socially responsibly and offering staff a fair reward for their work.
And this creates a massive tension. They state a commitment to fair reward, yet they operate in an industry defined by poor pay and long hours.
This contradiction links directly to their principal risks, which the board oversees through their audit and risk committees.
And we can summarize the set of principal risks immediately. First, competition. Losing market share due to inadequate strategic response.
Second, pricing. Failing to achieve the optimal balance between high-rate low occupancy and low-rate high occupancy, a clear link to their manual pricing lag.
Third, reputation. Damage from failing to deliver the promised high-quality experience. Fourth, technology. Reliance on the availability, security, and performance of the internally hosted website in HMS.
Fifth, data security. Non-compliance with Essland's strict data privacy laws leading to fines.
And finally, number 6, people. Failure to attract, retain, motivate staff, or fully embed the stated values, resulting in impaired service quality.
That people risk is the canary in the coal mine, and we are about to see just how stark the operational reality is compared to the stated value of fair reward.
Let's look at the numbers. Let's track Levwell's performance over 5 years, from 20x1 to 20x5, and seek the evidence that explains that remarkable 14% profit margin.
The revenue trend shows solid growth. Total revenue climbed from $182 million in 20x1 to $229 million in 20x5.
Which indicates that their slow, organic growth model is effective at expanding their market footprint.
We have to note the blip, though. Revenue dipped from $217 million to $210 million in 20x4.
Right. This minor contraction confirms their high exposure to the economic downturn, which hit their price-sensitive leisure market hard that year.
But the subsequent strong rebound to $229 million in 20x5 demonstrates impressive resilience and recovery speed.
Moving to occupancy rate trend, the chain performs exceptionally well here. It's consistently fluctuating between 73 and 78%.
And remember, the Essland benchmark for good is 70% annual average occupancy.
So Levwell is consistently outperforming the market average in filling its rooms.
Their peak was 78% in 20x3, and although it dropped slightly in 20x4, mirroring the revenue dip, the fact that it recovered to 77% in 20x5 shows they are highly effective at utilizing their capacity.
Even with a suboptimal manual pricing system.
And this success translates into RevPay, or revenue per available room, which shows growth from $121 in 20x1 to $136 in 20x5.
RevPay is the ultimate metric of asset management, blending occupancy and pricing. Their growth here confirms the overall health of the business and their ability to successfully manage the trade-offs of their lower ADR rural locations.
And now, the explanation for our central puzzle: the operating profit margin trend. This metric has remained remarkably stable, never dipping below 13.2% and peaking at 14.1% over the 5 years.
This is the financial anomaly. They are generating profit margins 30 to 40% higher than the industry benchmark of 10%.
So this suggests that the combination of their unique, non-standardized brand, which likely allows them to command a room rate premium from leisure guests, and strong, centralized operational control.
Particularly over general procurement and their owner-managed structure.
Yes, it gives them a powerful and sustained competitive advantage. They are just running a tighter financial ship than their rivals.
Switching to non-financial KPIs, the guest satisfaction score measured on a 1 to 5 scale is consistently positive, ranging from 4.2 to 4.5.
Which validates their mission. The exceptional experience is largely being delivered.
But the score's not perfect. They're consistently missing that 5.0 target, indicating there are sporadic lapses in quality, service, or consistency.
And the reason for those lapses is made frighteningly clear by the final metric:
the employee turnover rate. This is the ultimate strategic conflict point. The turnover rate is consistently and alarmingly high, fluctuating between 38 and 41% across the 5 years we analyzed.
40% turnover. That means that roughly 4 out of every 10 staff members must be replaced and retrained every single year.
Every year. This constant churn places immense stress on the remaining staff, dramatically increases training costs, and fundamentally threatens the consistency of that high-quality, personalized service required to maintain a 4-star experience.
And that 4.5 guest satisfaction score.
Exactly. This is the operational weakness directly contradicting their stated value of offering staff a fair reward and prioritizing care.
So Levwell has successfully monetized its brand proposition, achieving superior margins, but it has done so atop a foundation of systemic staffing instability endemic to the industry.
The high profit margin is built on a high turnover labor model, and that reliance on constant replacement is the single greatest threat to its financial sustainability.
In short, Levwell has proven it can make money and please guests, but it has yet to prove it can keep its people.
And that people, principal risk, driven by that 40% turnover, is the Achilles heel that could cause their high-margin operation to collapse if service quality eventually degrades.
So to sum up,
ultimately, Levwell PLC is a textbook example of a mature, profitable 4-star chain with a strong, distinctive owner-managed brand. They have successfully positioned themselves to command superior margins compared to the industry average.
However, that success is overshadowed by some severe internal challenges. Navigating extreme seasonality, maintaining quality amid a crippling 40% staff turnover, and managing the significant technical risks and operational burdens associated with hosting their critical HMS infrastructure internally.
Which also prevents them from leveraging dynamic pricing optimization.
Right. Their current profitability rests on high guest satisfaction. But service quality is fragile, directly linked to that high turnover rate.
So solving the people crisis is not merely an HR issue. It is a critical requirement for maintaining the competitive advantage that allows them to hit 14% operating margins.
Which leaves us with a final provocative thought for you to consider, based on the challenging financial climate in Essland. Levwell's entire identity is tied to the unique, non-standardized designs and the tight control afforded by the owner-managed model. If they were to participate in the emerging industry trend of hotel sale and leaseback arrangements designed explicitly to boost corporate liquidity, how would that shift in property ownership impact their ability to maintain both their highly individualized properties and their centralized, owner-controlled operations?
Would they be forced to sacrifice the very essence of their brand to gain short-term cash flow? Something to ponder as you reflect on how deep financial and operational decisions can fundamentally alter a company's strategic character.
That's all for this deep dive.